Oh man, so we just got our reading for the August non-farm payrolls in the States, and the readings were a disaster. Could this now mean that tapering is all but off the agenda for the rest of this year? Let's take a look at how the markets are responding. So we can see the S&P is pretty flat, you can see the Dow is pretty flat, and Nasdaq is up 0.2%. We can see that the 10-year Treasury bill spiked at the reading. You can see how it just quickly surged up. Now we're sitting at 1.33 on the 10-year as people are now more confident flocking to equities, given that they feel tapering is off the agenda. But what happened with the jobs reading? Well, the market was expecting 733,000 new jobs to be created. 235,000 were created. That is a massive miss, and it's a massive drop from the month before, which was revised to just over 1 million jobs in July. So we had an early summer increase in the number of jobs, and you can see that the Delta variant has really taken effect on the number of jobs added in August, both from a company standing back point of view and less keen to hire, but also from an employee point of view that they're not taking the jobs. And we'll touch upon that shortly. Now, we also, of the jobs created, you can see here retail contributed minus 28.5, professional and business services led the charge with 74,000. We saw education contributed combined government and private 200k in July. But mainly you can see that the government also had an impact, because we mentioned in the previous video, over the last few months, the government sector service jobs really did contribute a lot of non-farm payrolls, and that's now stepped back as we were concerned about. Now, looking at the unemployment rate, we ticked down a further 2.2% as expected, met the expectation of 5.2%. So again, bringing us to a new low of unemployment in the COVID-19 era. Now looking at your average hourly pay went up by 0.6 versus 0.3 expected. That is month on month. That is really high. For payrolls to go up 0.6 month on month is another really steep climb, and it suggests almost 5% per annum if you carry that on, inflation in wage growth. So that's also a bit of a concern in terms of the wage growth. And that kind of sums up the story of what we have going on here. So obviously with the onset of Delta in the period of August, you saw a lot of companies now starting to hesitate with mass hiring. So they put their foot on the brake in terms of the hiring, but also there's a mismatch between the job openings, because there's still a record number of job openings, over 10 million jobs posted as available, and what employees are willing to take on as a job. We know that employees are looking for more remote work, safer opportunities, more stability, and therefore the expectations of the types of jobs they want are very different to the 10 million available as job openings. And that's why you're seeing the average hourly earnings go up, and you're seeing misses on the non-farm payrolls. So what does this mean for the economy now? So what you can see here is obviously with the 10-year spiking, this is a flock to high risk, right? So when the 10-year goes up, this indicates when the yield on the 10-year goes up, that's because less people are buying the 10-year Treasury bond because they're taking more risk in equities. Now, you may be asking, why are people now flocking into equities? Because now, with this low jobs report, this has given investors the impression that we may not see tapering announced towards the end of this year now. So already it was looking like it was unlikely for Jerome Powell's meeting at the end of September, on the 22nd of September. But now people are starting to think, could this delay tapering till at least next year? Because Jerome Powell was saying, I wanted to see more data and I wanted to see substantial further progress, right? And this is a kick in the face of his substantial further progress. So for him to be able to justify a tapering now, it will be very high risk for him to do that any time over the next 2 months now, as that could lead to a taper tantrum, as the markets won't be expecting it. They're moving their funds now across to equities, and this could pave the way for a good rally in equities over September and October, because now the hurdle of tapering has been all but cleared. So that's a really interesting point. So we could see this flight to risk now from the Treasury bonds across to equities. Now, historically, what happens? So when the tapering process begins, what happens is the government starts to reduce its 120 billion of purchases, right? So they buy less bonds. If they're buying less bonds, the price of bonds go down and therefore the yield goes up. When the yield goes up, that's when people will move their equities across, theoretically, to the higher yield generating risk-free bonds. Okay, so tapering would indicate a rotation to safety, whereas a lack of tapering indicates a rotation to risk. Okay, and that's what we're seeing here. We're seeing a bit of a risk-on climate right now, given that disastrous jobs report. I mean, that really has fallen quite a bit more than expected. I mean, the expected was 735, which was already below the previous month, and we wanted to see substantial progress. Now, if we were to look here, 235 takes you back to April 21. So think about April when vaccines were not even as proliferated. That is almost the level we're back at now. So we had a really strong period from May, June, July. July got revised up to over 1 million jobs created, and now we've fallen down to 234. So it's clear Delta is taking an impact. Now, obviously, we're still adding jobs, so unemployment is going down. We're getting closer back to the employment level bit by bit, but not at the rate that we were expecting. So you can see here, this is the reading we've got, 235 versus an expected 750, and the previous month of 943 has been revised to just over 1 million new jobs created. So, yep, definitely this paves a way to a risk on. I would not be surprised, as I've mentioned, to see a really powerful rally September and October. I think this all but clears tapering off of the agenda for the Fed meeting at the end of September. However, that being said, we do have an inflation CPI report on the 13th of September, which will add further data to Jerome Powell's and the Fed's decision making in their meeting on the 22nd. So there you go, guys. To summarize, we had less non-farm payrolls coming in. Leisure and hospitality added 0 payrolls versus 415,000 in July. So you can see they've taken their foot off the brake of hiring for leisure and hospitality. Education contributed much less. Manufacturing actually rose by 37k, mainly 24k of which was in motor. So motor are hiring more people to create cars, which we know there's supply chain shortages there. And professional and business services led the charge, right? 74k new jobs. And I think this is the type of jobs that people are looking for right now. They're looking for the remote type business, professional service type job they can do from home. It's safer. They don't have to mix with anybody. They can get the job stability. And it's more flexible to the way that people want to work. And I think the pandemic era has changed the way that what the relationship between employees and the employers and what people expect from jobs. So even though we have a record 10 million jobs available, for some reason these aren't getting filled up, and that's what's led to your average hourly earnings going up 0.6% month over month, which is massive. So there you go, guys. That's your update on your August non-farm payrolls. We'll be looking forward to seeing how the equities move on this, and I'll see you in the next one.